Have you ever held Samsung, skhynix, or Nvidia in your portfolio and felt that quiet knot in your stomach every time an AI headline hit? Here's a number I want you to hold on to for the next 9 minutes: 14 cents. That's how much profit is left over from every single dollar one of the biggest AI infrastructure companies in the world earns right now. And by the end of this video, you'll understand exactly why that tiny number could be the real reason the entire AI trade unwinds. Not a scary chart, not a Fed decision, that number. Here's the conclusion up front. If this AI bubble actually pops, the trigger won't be that US stocks got too expensive. It'll be China's open weight strategy. And by the end of this video, you'll look at every semiconductor and AI stock you own through a completely different lens. So why does this video matter? Once you understand this structure, you stop reacting to every headline and start seeing where money is actually flowing and why. I'm Moon. I obsess, genuinely obsess, over where money moves through US semiconductor and AI infrastructure. If you've been asking yourself, did I miss this rally or is it too late to get in? Hit subscribe. And if this helps, drop a like too. You've probably seen the headlines: AI bubble, .com 2.0, analysts throwing around scary comparisons every single week. I actually had a friend message me last month asking if he should sell everything after watching one of those videos. And that's exactly the kind of panic this video is here to prevent. But almost none of them are asking the one question that actually matters. Most people believe this bubble will pop simply because valuations got too high. But honestly, that's only half the story. Valuation is a symptom, not the root cause. To find the real cause, we have to first look at how money is actually flowing into US AI infrastructure right now. And this is where that 14-cent number comes back. In Oracle's fiscal third quarter this year, the company earned roughly $900 million renting out NVIDIA-powered servers. But of that revenue, actual gross profit was just $125 million. 14 cents of every dollar earned. There it is. That's the number from the top of this video. And here's part of why that number is so low. These companies are burning through billions in chip depreciation and power costs long before that revenue ever turns into real profit. To put that in perspective, that's a thinner margin than a lot of ordinary grocery stores run on. And grocery stores aren't burning hundreds of billions of dollars a year on new equipment. Compare that to a well-run cloud software business, which typically keeps somewhere between 70 and 80 cents of every dollar. That's the gap this entire industry is betting will close over time. And yet, Samsung and SK hynix have announced plans to pour roughly 800 trillion Korean won, hundreds of billions of dollars, into semiconductor investment. That same day, hedge fund investor Michael Burry disclosed short positions against NVIDIA, Applied Materials, and Tesla, calling this wave of investment the beginning of the end. Here's what most people are missing. The low margin itself isn't the real problem. Why it's shrinking and what's about to shrink it further is the real problem. Since DeepSeek released its R1 model last year, Chinese AI models have rapidly expanded their global footprint by leading with low cost and strong performance. Recently, Alibaba released Qwen 3.8 Max, it's a 2.4 trillion parameter model, as open weight, and Moonshot AI's Kimi K3 followed the same strategy. And this isn't one lab getting lucky. It's Alibaba, DeepSeek, and Moonshot AI all moving the same direction at the same time, which means it's a strategy, not a coincidence. And because these are open weight models, anyone, a startup in Vietnam, a bank in Brazil, a US company trying to cut costs, can download the weights and run them on their own servers for close to nothing. Now, that's not a discount. That's a completely different distribution model. Here's why this strategy is dangerous. US AI companies need to sell closed models at a premium to recoup that 800 trillion won infrastructure bill, while China is doing the exact opposite, giving models away for close to free and undercutting that entire recovery formula. The Financial Times reported that Kimi K3 poses a real threat to US companies like Anthropic and OpenAI, which have kept their most advanced models closed. And here's where it gets really interesting. This isn't just Chinese AI is cheap. This is the US containment strategy itself backfiring. So far, the US has tried to slow China's AI expansion domestically through high tariffs and bans on advanced component use. But Bloomberg reported on the 21st that for resource-limited countries, China's AI models have become an option too cheap and convenient to ignore, meaning the spread is essentially unstoppable. And the U.S. containment strategy is hitting a fundamental wall. And here's the real irony. U.S. private companies have already started relying on these cheap Chinese models themselves, which means Washington can't crack down hard without hurting its own companies first. And if Chinese models keep eating into demand for premium AI subscriptions, that pressure eventually flows backward into chip orders too, which is exactly the kind of ripple effect that shows up in earnings calls months before anyone connects it back to this story. Meanwhile, China is doing the opposite at home. Its Ministry of Commerce recently convened companies including Alibaba, ByteDance, and Zhipu AI to discuss restricting overseas access to their most advanced, still unreleased models. Put it all together. China's strategy is to flood the world with models so cheap and open that they undercut the business model your competitors built, while keeping its own crown jewel technology locked down at home. Now that you know this, here's what you can actually do with it. First, if you're holding AI infrastructure stocks, check margin structure, not just revenue. Companies like Oracle can grow revenue fast while margins stay razor thin, and that's exactly where stock prices get shaky first. Second, figure out whether a company earns its premium from a closed model or whether it's directly exposed to open source competition. That distinction is going to drive stock differentiation from here. Third, areas with real physical moats, like advanced memory chips or leading-edge foundries, are naturally more insulated from this specific fight. That's the distinction worth watching. Now, you're probably thinking, but AI demand itself is still exploding. Isn't that the real story? You're right that demand is real, but the fight isn't about whether demand exists anymore. It's about who gets to fill it at the lowest cost. And you might also be thinking, isn't cheaper AI just good for everyone? Need more access? Faster adoption, bigger market overall? Sure. But good for the world and good for the stock you're holding are two very different questions. So it's not that valuations collapse outright. It's that the margin assumption propping them up collapses. That's the real trigger for a bubble. Reports have indicated that internal U.S. government assessments have flagged AI investment as excessive relative to expected returns, warning that a shock to financial markets is possible if monetization doesn't materialize quickly. So that's my read. The real trigger, exactly as the title says, is China's open-weight expansion strategy. Let's wrap up what we covered today. Remember that 14-cent number from the very start of this video? That's not a footnote. That's the whole thesis, compressed into one number. This isn't a fight over whether valuations are too high or too low. It's a fight over whether that premium can keep getting paid. And right now, China holds half the answer to that question. This is a structure worth watching closely, and I'll keep tracking exactly where this money moves every week for you. And look, I know it's tempting to just chase whatever's green on your screen this week, but the accounts that actually compound over years are the ones built on understanding structure, not headlines. If this video saved you from getting blindsided by a headline you didn't understand, that's exactly why I make these. Subscribe, hit like, and let's keep learning this together. Protect and grow what you've built.